Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I am going to look at one of the requests that you guys have made. So recently I made this post and I've asked you guys to give me some of the stocks that you would like. One of the stocks that you've said is EL, and I'm going to look at that in a second. But before we do that, I'm gonna quickly show you. I don't know if some of you own Salesforce, but they are reporting today after the market closes. Salesforce is going to report today. They've already kind of preempted this. Basically, the things are not looking great this quarter, so we'll see. We'll see what comes out tonight. It might go down again another 5-10%. It might go up again. I don't know exactly what's going to happen. I don't own any of the companies that reported this week, apart from the one company that I'm really interested, and I'm going to look at it after this video in more detailed. Is CrowdStrike. CrowdStrike reported last night, but today they're actually down to almost 20%. So it'll be interesting to find out exactly what happened with the business in terms of revenue, in terms of things like that. I'm sure it's a lot to do the cybersecurity in terms of their revenue. I don't think the revenue will slow down, but I think a lot of the companies might stop spending money on cybersecurity side of things. Okay, because they're probably worried more about what is happening in the economy rather than just spending a lot of money to protect their data or whatever the case might be. I genuinely don't know. So we will see. We'll see. I'm going to look at it today and basically find out exactly what has happened. But the company that we need to look at today is Estee Lauder. This company owns loads of different brands. I'll show you that in a second. And as you can see, they are down 39% for this since the beginning of the year. So it's one of those companies that were going up almost on a daily basis. You can see $371 per share at some point. January the 4th, that's where they were. And right now, as you can see, it's $225 per share. So one of you asked me if I can look at this company. They own loads of different brands, and I'm sure you've seen this. Okay, my dad loves this perfume, right? One of their brands. So yeah, you from Bobbi Brown to, for example, what else do they own? Actually, the Estee Lauders, the Joe Malones, and then so on. I think Bobbi Brown or whatever. So they own loads of different brands. So they're not just one specific. They don't own one specific product. And if you are married, I'm sure your missus is probably spending a lot of money on these items that this company have. You're probably buying perfumes from this company. So why not look at it in terms of they are in the consumer defensive side of it. So it might be a good addition to a portfolio that is kind of looking for that consumer defensive stock, if you like. So what I'm going to do now is I'm going to look at the financials from that side of things and then obviously share it with you. And like I said, they own loads of different brands. And as you can see here, so there's some of their products, for example, the skincare is actually 56% of their physical year in terms of 2022 came from from the skincare. Makeup was about 26%, and then 14% came from fragrance, and then 4% came from hair care. So as you can see, they're very well diversified, and they are basically everywhere. If you go to any of these shops that sell perfumes or makeup, whatever, you will definitely find a product this company owns. And that's the beauty about this type of company. And because they are in the consumer defensive, they're not technology. That's a mistake. And as you can see right now, the price is $224 per share. EPS of $6, market cap of 78 billion, 78.5 billion dollar market cap, and it has a wide economic moat, which is quite interesting for this type of business, which is quite good in fact, because when you see this type of business, obviously anyone can copy their business if they don't have a competitive advantage, but for this company absolutely does. And beta is below 1, which means basically it's not as volatile as the rest of the market. PE is quite high, 37.55, but historically this company trades higher multiples, which is interesting if you think about it. And I'll show you one of the reasons I think this company has been trading basically higher is because of the growth. So when you look at it, let me quickly show you here. In terms of total return in the last 5 years or whatever, you can see in 2017 total return was 68%. Then it went down to 3.5, then it was 60%, then it was 29%, then it's almost 40%. And this year, obviously, because it's down quite a bit, the price appreciation side of it, basically, is down about 41% total return this year. So it's probably that's why the company is actually trading at higher multiples. But when you also look at the free price to free cash flow, you're looking about 53, and that's very, very high. And when you look at this PE and you look at the sector, 25, and right now it's still 37, considering it went down from 300 something to right now 200 something, it's still expensive stock if you think about it when you look at the PE. The annual dividend yields just above 1%. Latest increase was 10%, and the 5-year growth rate is 12%. But they've only increased that dividend just for 2 years. The payout ratio is 36%, and the dividend safety is 70%, which is basically what we look for. And what we normally look for, and what simply Wall Street, safe dividends is actually looking for, is 61% and more. Free cash flow, you're looking at $1.5 billion, which is enough to cover the dividends or so. Profit margin 12.7%. I thought it would be slightly higher for this type of growth company, but it's all right. Operating margin of about 17%, and then total basically return on equity 37%, which is quite high, right? Total returns the last 10 years, we're looking at about 15%, which is absolutely brilliant. And current ratio is above 1, which tells us the company has enough assets to actually cover the liabilities in the next 12 months. In terms of growth, we're looking at growth estimates for the next year is 33%. So considering what we've already seen in terms of total return, this is not a surprise to me at all. But the next 5 years per annum, we're looking at about 5%. But just next year, okay, is 33%. Current share price is 225, like we've seen already. But when you look at the fair value right now, it's $217 per share, according to simply Wall Street, and that's just about the fair value right now, right? The fair value for Morningstar is 273, so they're slightly more bullish. So because they have got 21% discount right now, that's what they think. So the company is undervalued at the moment as we speak, according to them, right? And then total, in terms of tip ranks, they say next 12 months, the price target is for the next 12 months, 243. Okay, that's about 7-8%, 8-9% an upside from where we are right now. And according to them, it's actually moderate buy. So in terms of their revenue in the last 4 years, we're looking at about 14% to right now 17%. So sorry, $14 billion to $17 billion, which is basically it's going the right direction. It's going the right direction. So 14, 16, then 17, okay, and then right now 17.27. So in terms of their gross profit, from 10 billion to right now 13 billion. So actually they are retaining a lot of that money. And the net income from 684 million to right now 2.1 billion. That's massive jump, right? EBITDA from 1.8 billion to right now 3.9 billion, and free cash flow 1.7 to then 1.6, the slight decline in 2021, and then 2022, their fiscal years I think soon, so 2.9 billion to right now basically it's kind of decline of 1.4 billion. So it'll be interesting to find out if it's because maybe they're holding a lot of inventory or whatever the case might be. We'll find out what it is. And in terms of price and shares outstanding, they actually have been buying. It's slowly, it's not a lot, but they have been buying their own shares. So at least they're not diluting your own shares. This is one of the most important things for me, because I don't like when big companies like this company but basically dilutes the shares. If it was CrowdStrike or Tesla, these companies do actually like to, because remember these companies are growing, so they need the money. Instead of getting into debt, they actually issue more shares, and then for that reason they actually use that money to invest in the business. But a company that has basically been around for a long time and has a product that actually making profit, then you shouldn't be buying. You should be buying your shares. If not, you should be leaving it as it is. You should not be diluting the shares, okay, outstanding shares, because that does not help us. In terms of when we look at the Sharia compliance side of things, in terms of business screen is absolutely fine, 100%. In terms of interest bearing, really low interest debt, okay, and then interest bearing security is only 4.1 as well. So it looks at business wise. I do like the business model. I like the fact that they've got so many well-known brands. But my concern, despite even Morningstar saying this company is undervalued at the moment, my basically worry is the fact that it's trading very, very high multiples. And when you look at that sector, when you look at the consumer defensive, there are companies in there. If you're looking for that, basically the consumer defensive stock, there are so many companies in there that might not be growing 33% next year. Okay, they might be growing 5 to 10%, and that's probably why you're paying the difference, obviously. But I would rather own a company that is just in case anything happens, because remember, we always said to you guys, make sure you got a margin of safety. So if I was to buy this company at 33 multiple, right, anything 37 multiple, anything can happen, and then it might keep going down and down, and then you basically lose a lot of money, and for it to come back and bouncing back from where it is right now, it might take a very, very long time. So the moral of the story is just to right now, I know one of you have asked me to look into this company. So I would say to you, brothers and sisters, if you're interested in this company, probably wait until hopefully it comes down to a maybe in the 20s, 25 maybe. Okay, but right now it's very expensive in my opinion. And even when you look at the price to free cash flow of 53, that is very high. This is technology companies. This is high growth companies territory. So it's not consumer defensive style. Okay. And I think a lot of it is because investors are putting money into this company because this is what they see. That growth next year, 33%. Oh, okay, cool. I'm all right to, because remember, it's the risk reward. So if you're willing to take the risk, you might get the reward for it. But if the risk is greater than the reward, then obviously you don't touch these kind of things. And in terms of business side of it, in terms of what we can see here, it looks like it's a decent business. And the fact that they own so many well-known brands, okay, they're not going to run out of business or basically go out of business anytime soon. But the danger is, because we are now in the potentially in a recession, who on earth is going to go to these companies and buy a product for £100? Because some of their perfumes, some of their makeup, some of these things cost a lot of money. So that is the only thing I would be worried about. Consumer discretionary right now, okay, people will probably want to basically eat rather than actually buy perfumes and so on. So that is my risk side of things. So if you were interested in this business, obviously because you've asked, I would wait a little bit longer to see how things go in terms of the macroeconomy, as well as basically hopefully this PE coming down. That's my take on this company. I hope you enjoyed. What I will be doing is I'm going to group some of the companies that you guys mentioned and put 1 or 2 videos out in the next couple of days based on your recommendations and based on what you've asked me, inshallah. As you can see, the portfolio is still going. Okay, see, it's still in between 61 and 62,000 pounds. So this week I actually added a little bit of money just to buy the companies I normally buy every week. There's not that many companies that are undervalued at the moment, so we'll be interested to see what I'm gonna do next few weeks. So I will be doing this weekend, inshallah, I will be doing a portfolio update. Although we've done one very recently, I'm gonna do a quick one at the beginning of the month, and then I'll do another one end of that month, inshallah. Have a wonderful day, and please, if you are watching the video still, please give the videos a like. It really genuinely helps the channel. Assalamu Alaikum. Take care.